Hey everyone, welcome back to Finance Flicks Hub, your go-to place for clear investing insights, market breakdowns, and the lessons that help you grow smarter with your money. Last Friday, the markets looked like they were crashing. The headlines were alarming, prices dropped fast, and investors started to panic. But here's the truth. It wasn't the end. It was a reset. And if you understand how market cycles work, that kind of reset can create real opportunity. So today, let's break down what really happened, why the sell-off occurred, and what smart investors can learn from it. 1. The shock that hit the market. Late in the week, new trade tensions and tariff concerns surfaced, creating sudden fear across global markets. The reaction was intense. The Dow Jones dropped almost 900 points. The Nasdaq fell more than 3%. Major tech names, including chip makers and device suppliers, saw losses between 2% and 7%. The VIX, often called the fear index, jumped above 30. It looked like chaos, but this reaction was based more on emotion than fundamentals. The economy didn't suddenly break overnight. This was about uncertainty, the calm before the panic. For weeks leading up to that drop, technical signs were flashing warnings. Stock prices had been stretched far above their short-term moving averages, and trading volume was thinning out, a classic sign that momentum was fading. That's when experienced investors began preparing. They reduced exposure, built up cash positions, or added protection to their portfolios. So when the sell-off came, they didn't panic. They followed their plan. Because smart investors know pullbacks aren't the end. They're part of the process. 3. The news was the spark, not the cause. The trade headlines were simply the spark. The real issue was that markets had become overheated and overly optimistic. When uncertainty hit, it exposed that imbalance. This wasn't about companies losing profitability overnight. It was about emotion taking over logic. Markets move not only on data, but on how people react to that data. 4. The bigger picture, still a bull market. Despite the sudden drop, the overall uptrend hasn't disappeared. The S&P 500 is still showing strong year-to-date gains. The Nasdaq remains up double digits for the year. A single rough day doesn't change a long-term trend. Healthy markets go through periods of rest, and that's exactly what a reset like this provides. 5. Market experts see opportunity. Several analysts have pointed out that sell-offs like this often turn into short-term opportunities. When fear dominates, strong companies start trading at better prices, and disciplined investors quietly begin to buy. We've seen this pattern before. Volatility spikes, prices fall, and then stability returns as fundamentals take over again. 6. The mindset that sets winners apart. Most investors zoom in too closely during volatility, watching every tick, every red candle, every headline. But the ones who succeed zoom out. They know that short-term moves are just noise in a long-term story. If a company's earnings, innovation, and customer growth are still intact, then a pullback is often just a buying opportunity disguised as panic. 7. How prepared investors stay ahead. Before the decline, disciplined investors already had risk management plans in place. They trimmed overextended positions, used long-term hedging strategies, waited patiently for better entry points. When the drop came, they didn't freeze. They executed calmly. The key lesson: have a system before the storm hits. 8. Signs the market needed a break. Before the correction, charts showed prices far above 20-day and 50-day moving averages, volume weakening even as prices climbed, market sentiment at extreme optimism. Those are clear warning signs of a coming cool-off. They don't mean a crash, just that markets need to breathe. 9. The real question. After any drop, after any pullback, ask this: did anything actually change about the companies I own? If the business is still strong, customers are still buying, and profits are still solid, then nothing truly changed. Market fear is temporary. Business strength lasts, and that's where patient investors find their edge. 10. Checking your conviction. Here's a quick framework to use. Are company earnings still stable or growing? Are customers still spending and using their products? Is innovation or leadership still driving growth? If those boxes are checked, volatility might just be noise. But if those fundamentals start breaking, that's when you reassess. 11. Defense first, then offense. When markets turn volatile, your first move should always be defense. Protect capital. That means smaller positions, longer time frames, stronger risk control. Then, once markets find support, often near 20 or 50-day averages, you can go on offense, buying quality names at better prices. This balance between patience and readiness is what long-term success is built on. 12. The market cycle never changes. History has shown that market fear tends to move in cycles. Fear hits, prices drop, stability returns, confidence rebuilds. Experienced investors don't fight the cycle. They work with it. They buy strength after weakness and stay steady when others overreact. 13. Discipline is the real advantage. The biggest difference between panic and profit is discipline. Having a clear plan, sticking to it, and keeping emotion out of your decisions. One disciplined investor shared how consistent risk management helped them steadily grow their portfolio, not by chasing hype, but by staying calm when others weren't. That's the mindset that wins in the long run. 14. Final thoughts, from chaos to clarity. So, was Friday a crash? Not really. It was a reminder. A reminder that preparation always beats panic, and that smart investing is about patience, not prediction. Every dip tests your emotions, but it also gives you a chance to grow stronger as an investor. Stay focused on what truly matters: fundamentals, time, and discipline. Ending. And that's it for today's breakdown. What looked like a crash was really a reset, and a great lesson in how markets breathe, adjust, and create opportunity. Thanks for watching Finance Flicks Hub, where we turn market noise into knowledge. If you found this video helpful, make sure to like, subscribe, and turn on the notification bell so you never miss an update. Stay sharp, stay patient, and as always, keep learning. This is Finance Flicks Hub, signing off.